I'll talk about advanced strategies for some of the people that already know about self-directed IRAs. And I'll also talk about some of the giveaways that Grace worked for her group at the end of the meeting, so that you will get something for this. And we'll take questions anytime. As Grace said, just write them down and give them to her and I'll expound on it. I want you guys to get the information from what we have today. A brief bio that Grace was talking about. Grew up in Fort Lauderdale, born in Jersey, went to Cornell, launched rockets at Kennedy Space Center and Cape Canaveral Air Force Station, the shuttle. I'm very proud that SpaceX finally put manned space back in the U.S. territory this last week. I was very happy to see that. I hated them paying the Russians for the rides to our International Space Station. I started CamaPlan in 2004 with my sister Maggie because I was using self-directed IRAs, and several people in my inner circle said, why don't you do that because we trust you more. I've been investing in real estate since I got out of college, even a little bit before I got out of college. I still have the first piece of property that I bought. I am a buy and hold guy. I've had properties in 7 or 8 states. I'm cutting that down now as I'm getting older. I'm much older than 23, like Scott was. And I still own rental property. I don't like paying taxes. I've been married since 1981 to my wife. I've got 4 boys and 6 grandkids, so that's what takes up a lot of my time today. And I'm glad that I work for the financial freedom, because financial freedom gives me the time to spend with them. Sorry about the cough. 2 things I'm biased on, right? And one is tax-free. I love stuff tax-free. And the other one is real estate as an investment. I've tried a lot of investments. I've owned oil wells. I've tried the stock market. I would rather play blackjack to make money than I would the stock market. I bought books on both of them, and I do better in Atlantic City than I do in the stock market. So I will be referencing real estate and tax-free throughout this presentation, but I want you to understand that no matter where your expertise is, some of the tools I'm going to give you will work very well for you in the future. I think it's one of the best wealth building tools that I've come across, and I don't know, many things better than this, and that's one of the reasons I started the company and still have it today, along with the real estate. We were investors, so I wanted to set up a company, for investors. And one of our slogans is for investors, by investors. So I set it up the way we would like to be treated. So why does it work for investors? Pretty simple. Everybody, once they get a feel for it, loves tax-free income for life, right? And by the way, banks don't give you any more credit on your credit score when you're borrowing money just because you have a tax-free Roth account compared to a tax-deferred traditional IRA or 401k. But I believe the tax-free Roth is way better. Tangible assets, I like the tangible assets. I used to own Wachovia stock. It went to 10 cents from $30 over one weekend back in 2009. I have access to the managers of real estate or the funds I invest in. I have more control, it's less expensive, and it's the only way I personally know to get real diversity by investing in different things I understand in. And 40 years of investing in real estate, notes, mortgages, tax liens. I've pretty much seen it all. Anything real estate related, I've probably touched at some point in my life. So that's why investors like self-direction and why they want those in their qualified plans. How hard is it to do it? How it works? Basically, you open up an account just like you would at Merrill Lynch, Fidelity, Vanguard. It doesn't matter. You just open up those accounts. Excuse me. And then you transfer funds over there. You can transfer a little and try it out. I call that toe dipping. You can roll over some from a 401k, or you can just make a contribution into an IRA. All the rules are exactly the same. Once you have your account set up and your money there, now you choose something to purchase. What would that be that you choose to purchase? The investment would be it real estate, be it a note or a mortgage or an investment into a syndication. That paperwork comes to us after it's reviewed. You sign it and tell us this is what you want to do. We'll sign the documents and send the money, and then you'll look online and see your profits come in based on the payment schedule that you had set up. Sorry about that. And Grace, you were talking about earlier, someone was about putting deals together or syndications or multifamilies. A lot of people can't buy multifamilies by themselves. So they go out and they do a syndication or a LLC or some entity, and they will go look for other people's money, and you can become an equity stakeholder into it. We help people do that. We'll streamline the process. We can do it online or with paper. We'll introduce our account reps to them. We'll have investors and prospects will show up to webinars, and we'll help anybody that wants to get that money working together and set up so that they can gather money and build it. So let's get what is a self-directed IRA. And this is a definition that I had an attorney define 15 years ago when there wasn't any information on self-directed IRAs. I started off finding out about self-directed IRAs in 1993 after my dad died, and he died land rich and cash poor, and he had a delinquent note that was at 28%, and I borrowed the money from a self-directed IRA, which was interesting to me, and I didn't understand it. But after I borrowed that money, I asked them, how do I get one of these? And they told me, please don't contact us. You don't have enough money. We appreciate your business, but you can't have a self-directed IRA. So that aggravated me a little bit, because he was making 12% on a very low loan to value, and I knew that it was a good deal because he was making 18%, anywhere between 12 and 18%, and he wasn't afraid of foreclosing on me because he actually wanted to and take the property, is what he told me. So I went out to the IRS and went back to Cornell and asked them to help me find information on self-directed IRAs, and didn't find much there. But the internet was being invented at that point in time, and I don't know if it was really Al Gore or not, but I found out about self-directed IRAs through the internet and kept pulling on the thread, and it helped me finally build the business that we have today. And basically what this allows you to do is use your IRA and invest in anything that you want. This is a quick definition. Wikipedia has a great one. If you want to go on there and look it up under Wikipedia, it's only about a page and a half. And then there's all kinds of books and IRS publications on it, etc., that are available today. Let me see. Sorry about that. Flip to the next one. So what's the difference? People ask me about a self-directed IRA and the IRA that you have now. Basically, all the rules are exactly the same, right? But your statements are going to look different. On your statement with, let's say, Fidelity or Vanguard, you're going to have stocks, CDs, or mutual funds in them. Almost everybody, that's the majority of what their IRAs are made up of. And in our case, you're going to have either real estate, notes, tax liens, private placements, gold, silver. We even have some that have llamas and other exotic investments, but it lets you invest in what you know and understand. And all the transfers, rollovers, contributions, distributions, age limits, required minimum distributions, all those rules are exactly the same. But you can just roll over, as I said earlier, or transfer money from an existing IRA or 401k to a self-directed company like CamaPlan, and then you're going to be set up to go and buy real estate, notes, tax liens, et cetera, that are there. Whether you're buying turnkeys like Derek was talking about. Scott does all kinds of deals. He does a few flippers and things from that aspect. So the other thing that I found out for newbies, I think Jane said she was new on it. But if you have an IRA or 401k, one of the things that are kind of cool to do is get with somebody that's very seasoned and good at flipping if you want to do flipping or buy and holds or something like that. And if you can lend them money out of your IRA and be a hard money lender with a better rate than some of the vendors, I guess Seton was there, and you heard what they liked, at that point you can learn and still make money at the same time. So I kind of talk at loaning your way to mentorship. And I do believe that groups like Grace has put together here really helps you learn, and everybody's friendly and they like the camaraderie. And I love to learn from my mistakes, but I much more prefer learning from other people's mistakes. It's less expensive and less painful. So use this group, use Grace, and she'll connect you to whoever needs to be connected to help you with whatever you want to do. And in real estate, there's a lot, right? There's the fix and flippers. There's the, buy and holds. There's the watchdogs. There's the wholesalers. So figure out where you want to be if you're new, and ask some of the other seasoned, experienced people what it is and how they do it. And I think you'll end up in a good spot as you move through the steps and the learning process. So what does CamaPlan do? Why am I here today? Okay. The reason I'm in business is because the IRS requires you to use a third party to open up an IRA. You can't open up an IRA outside of a bank or someone licensed to do that, Fidelity, Merrill, Vanguard, etc. So we are one of those people. When you transfer money to us, there's no taxes, there's no reporting, etc., until the money gets to us. We're a neutral third party. We don't give any investment advice. We don't have any products to sell. We're not, coming up with the deal of the week, the loan or real estate. You have to find what you're doing. I like that. We're completely transparent. You see what you get, and you find what you're going to get and invest in. And then we do the reporting to the IRS. We give you the 5498 so that you're not over contributing, and we're reporting all of those things to the IRS, just like Vanguard and Fidelity do for the stocks and bonds. But the real estate and hard to value assets that we deal in, they don't want to deal in. So it makes a nice niche for us. And if you're in real estate and you're good at it, again, you're going to have a tax-free account that gives you income for the, your life. And, now it was just changed. It used to be your life and your heir's life, but now it only goes for 10 years afterwards. That was changed at the end of 2019. So Fidelity, Vanguard, all these people self-direct also, they say, but they only self-direct in what they sell. All right, because we've had clients that say, well, you charged me to open up a self-directed account, Vanguard didn't, but then when they went to buy the real estate that they learned in our academy, Vanguard wouldn't buy the real estate for them, and then they learned what a real self-directed account was. So CamaPlan doesn't sell any assets. We basically let you invest in anything that isn't prohibited from the IRS. So that's, don't get fooled by self-direction at one of the bigger companies out there, because they only self-direct in what they sell. And here's the other thing, we like to keep it simple. And I just want you to look at the middle box on this screen, and that's alternative investments. That's all we're doing. We don't figure out risk management. We're not trying to take the place of your financial advisor. We don't sell life insurance. We're not doing coaching or coming up with strategies or retirement planning, healthcare, et cetera. None of that. All we do is allow you to invest in things that you know and understand and feel good about, and give you that transparency and that capability, so that you don't have the anxiety if you're like me and you're not good at the stock market. I've got a cousin who graduated from Princeton, and he's a wizard in the stock market, and I listened to him for about 45 minutes talking about derivatives, and the only thing that I learned is I never want to invest in a derivative. So, and I went to a good college supposedly, but this isn't the things that they taught you. Even in some of my economic classes, they said, in this, disregard taxes, and, as a result of this question, as one of the assumptions. If you can disregard taxes, that changes your whole answer, right? If you can get money, at least in my case, if I can get tax-free money, I can work half as much and get the same amount. So it's very important to me to minimize how much they take from me. So this is just one example here. 16,000 initially went in. We picked a 10% rate of return. And the reason I do that is because some people say, oh, I make 30% or 15%. Financial advisors tell you to look at 6%. And now CDs are the lowest I've ever seen them in my lifetime, at less than 1%. So it's, you got to figure out where you are. And we have an Excel spreadsheet that'll change these numbers and work the chart for you. But in this example, it was $16,000 initially invested, 10% return, and the people were in a 30% tax bracket. And if you look at the blue columns, that's money that's in a taxable savings account, and that's yours and what you're making on this. And the green is the money that's in a tax-free Roth account. And if you go out 40 years, you can see that you have 3 times as much money at $1 million. If it's in a Roth account, you're going to pull it out and it's worth $1 million. But this is the bite that taxes take from you. So each year they take those taxes and you don't have a chance to reinvest it. On the green side, you don't pay any taxes. And I say, I'm making interest on my taxes while you're paying taxes on your interest to other people that don't have these tax-free accounts. So any financial advisor will help you with these charts, and it doesn't matter what the investment is as long as it's that return. If it's a higher rate of return, the differences are going to be, even more. And if it's a higher tax bracket, they're going to be more in favor of the green. And if you put money into it every year, it'll even be more advantageous to be in the Roth. So if you look at this, you can see that this really builds wealth, okay? And I wasn't taught this. I had to learn it and figure it out and go through probably a dozen financial planners before I sat down and figured it out. And this was one of the things in my life that was very moving and changed my thinking going forward. And the other one was doing an amortization chart on a 30-year fixed rate mortgage and seeing that I was paying 3 times what I borrowed over my lifetime. And you know, so I kind of looked at that and I flipped the table and I said, where do I want to be, right? Do I want to be the borrower or do I want to be the lender? Do I want to be the landlord or do I want to be the renter? And those things kind of worked in my head. And to me, I made the right decision because, as I said, I now have the freedom to spend the time with my kids the best way that that I feel is important. My kids and my grandkids. What does your advisor think of all this stuff that I just talked to you about? I mean, I don't know how many people believe everything that I'm telling you here, but let me just tell you the 3 things that always come back to me, right? The first one is it's not legal. We can get you through that really easy. You can Google it on Wikipedia, like we said. There's books, there's IRS publications, etc. And so that's not really a problem. And if your advisor tells you that, he's not educated in this world. The next one they use is that this is too risky. Well, your money is put in an FDIC insured account until you're ready to use it, so that's not risky. So the investment that's risky is what you put that money into. And you're going to have to make that decision. For me, I looked at the stock market. Was the stock market risky? It was risky to me for darn sure. Was it risky to the stockbroker? No, because he got paid out of my money, whether he made me money or lost me money. So I had to ask myself, what's more risky, stock market or real estate? And that was an easy one, right? Stock market or gold, that was another easy one. Real estate or gold, I'm not sure even to this day which one is different. But every one of you have knowledge in different areas, and like you heard from me in the beginning, I've been doing this for 40 years, and I grew up around it. My mom and dad had their own apartment buildings when I was, as far back as I can remember, and my mom and dad had different philosophies on how they should be running things. So I saw both sides, and I saw the good and the bad, but I grew up around it, so I knew a lot about it. And then the other one, is it very complex? I mean, I can't answer that truthfully anymore because I've been around it so long that it seems very simple to me. But if it is complex to you, we have people in our office that will help you understand it and look at it and see it.
So Carl, I
and
have a
walk you
couple of
through.
questions for you. Thanks.
Sure.
Yeah. So I'm going to speak from my experience. I have a self-directed IRA, but it was a rollover from previous employers, and it was before taxes, so it's not a Roth. So it would be that blue graph part of the graph then for me.
Well, actually, it would still be the green part.
Okay.
Because you're not paying taxes out of it. But let's say you wanted to pull that $1 million out.
Right.
Today, you would, and let's just say you'd still be in the 30% bracket, 300,000, you'd pay 300,000 in taxes. But if you pulled it all out, you're going to be paying, about 40%. So your million would turn into 600,000.
So it all depends on when I pull it out.
And what tax bracket you're in.
Right.
When you pull it out. Yep.
Okay. And does it also depend on how old I am?
Once you're over 59 and a half, no. And if you're before 59 and a half, we can show you ways to get the money out without a penalty.
Ah, okay. All right. So in order to start a Roth IRA, which I've been intending to do for years, I would just like contribute to a Roth IRA. And do you help with the selection, or I mean, I don't know how that works.
I'm going to talk about the different accounts, but there's
Okay.
a couple of ways you can do a Roth IRA. One is you can start converting your traditional IRA that you have now. You can say, hey, I want to convert, 50,000 of that to a Roth and add that to your tax income this year, especially if you didn't make a lot of money and it was advantageous for you to do that this year because of COVID, et cetera.
Right.
That might be a good year to convert. Back in 2008 and 9, a lot of realtors didn't make any money, so they converted and took their losses and didn't pay any taxes when they converted from the traditional to the Roth IRA. Or you can start a new one and start making contributions as long as you're under $120,000 income single and 180,000 married.
Oh my.
So there's a couple different ways you can do it. You can talk to our office, or you can talk to a financial planner, or your banker, and they should all give you the answers to that.
Okay. Brad Anderson asks, so you put up some different custodians, I think they're called, but what's the difference between a self-directed IRA with someone like Equity or Pensco to buy real estate?
Well, Equity and Pensco are our competitors, so there's not a lot of difference, but our service, I think our service is better. I think our rates are better, and I think our people are better. And the other thing is, if you need to get a hold of me, I'm available, and I think I'm probably in the top 3 IRA specialists in the country.
I agree. Yeah,
Thanks.
you are available. I appreciate that.
Yep.
Okay, we'll let you roll.
Okay, thank you. So let's go over the types of assets that you can invest in self-directed IRAs. Obviously, real estate's at the top because that's one of my favorites and I'm biased towards it. But other people like the precious metals and like to buy silver and gold and then trade them. Another one I very much like are notes and mortgages. Private lending works well with the IRAs. Private placements, a lot of those are syndications or funds or LLCs that either buy notes and mortgages or buy multifamilies or buy commercial buildings. It doesn't matter, they can do that. And then there's all the other things that I talked about, tax liens, automobiles, llamas. There's a whole list, and we can kind of hit them real quickly. These are the different types of real estate that you can invest in, even foreign property investments, but you got to be really careful when you do that. I don't know what, I guess I didn't go into all the other ones. So let's talk about the money that we have out there right now in retirement assets. There's $9.8 trillion and this came from the end of 2019's data, right? Defined contribution plans have $8.5 trillion. These are different types of qualified plans. Government defined benefit plans have 6.4 trillion. Private company plans have 3.3 trillion. So there's $30 trillion out there that people are scared to death of the roller coaster in the stock market and are out there doing it. And then I think Jesse, Brad, and Scott, are realtors, I think, from there. And I don't know, if you could get all these people into self-directing and buying real estate, what's the commission on $30 trillion? Let them figure that out and tell us, right? or even if you got half of it, 15 trillion. So there's a lot of money that's out there for people to use. And I think it might have been, who was it that needed money and needed a help going on there? One of the
Joe.
people that,
Yeah, I think
Joe.
it's Joe. Yeah.
Yeah. So if he knows people with IRAs and he wants to get a better return, because trust me, these people are looking for places to put their money. They're yield starved. The CDs, I thought they were bad when they went from 6 to 2, but now they're below 1%. So people are looking at different assets, to try to put their money in, because otherwise they've got to go back to work, right?
Mm.
So Grace, based on what you said, let's talk about the types of different plans that are out there. The plans that I have in the green are tax-free accounts. The ones in black are tax deferred. The Roth IRA and traditional IRA are personal accounts that pretty much everybody that makes any earned income can have. The SEPs and Simples are business ones, and then you can also have spousal. If you work and your spouse doesn't, they can have an account based on your earned income. And a lot of times, if you have kids that are under 18 and they have a job, they can also get an account.
Mm.
Then there's the 401ks, okay? Those are business plans, and they have pre and post tax, right? The post tax or the Roth component of the 401k is like the Roth IRA. But what's nice about these is you can put in about 10 times more money than you can put into the Roth and traditional IRA, right? You can put, 6 or 7,000 in the Roth and traditional IRA, and you can put in 55 to 65 depending on your age in the 401ks. There's other defined contribution plans, and there are defined benefit plans that can also be self-directed. My favorite is the health savings account, and the reason I like that is the health savings account, the money goes in tax deductible and comes out tax free, and it's the only account anywhere in the government that works like that I know of. The Roth IRA, you pay the taxes when you put it in and you get everything out when it's free. The traditional IRA, you don't pay any taxes when you put it in, but when you take it out, you pay taxes on the crops. So that's the difference between those. The HSA takes the best of both of those. So anybody who's paying their own health insurance should be looking at a health savings account.
Should.
Okay. 20 ways your IRA can fund real estate. Joe should probably look at this, because if you only have a little bit of money in your IRA, I've seen people with 5 or 10,000 turn that into, 15 or 20,000 in 6 months to a year based on a flip and working with other individuals. So you can go through this. I'm going to give them a free report when they're, if they want to, they can do that based on our discussions earlier, Grace, and we can go through these things if they want to. But some of the things I've seen people do, to explode their IRA is you can buy a property subject to the mortgage. So you can put a little money down. I've seen some people take over properties, especially like in 2008 and 9. People put $100 in from their IRA. They took over the mortgage and bought a property, and then had the renter pay the mortgage. You can wholesale, direct, or you can wholesale a note. There was a deal where on 32 Country Club, this client was going to lend money for the deal, was actually going to buy it, and then ended up putting the money down and sold that property, and took that note, and it was 10 grand, and turned that note into 22,000, and sold the contract with it, and took a note on that for 6%. So they took, 10,000, turned it into 22,000 in less than 6 weeks instead of buying the property and flipping it. That was just easy money, and it just happened to do it. They were going to buy it and flip it, but they made 10 or 12,000 just by setting it up. Joint ventures also work. Some IRAs will lease properties and then rent them out and do Airbnbs. Other people will use options on properties to buy them. There'll be assignments. And then another advanced strategy is you can actually over contribute to your IRA if you really need to get money into it and pay a 6% tax until you take it out. So there's all kinds of things that are out there, and that's why we say, hey, if you have problems on this stuff, we can tell you what a lot of smart clients and a lot of their individuals, financial advisors and or accountants or tax attorneys have done for them. So use your self-directed IRA company to help you figure out what people are doing. Take advantage of their education. All of our education is free. We record things like this. It'll be on our website so people can listen to it if you give us the right to grace. And we do a lot of our own education that's all free on the website. Is there any questions that we want to go through at this point? But before we go into it too long, I want to make sure everybody understands that I can't give them all the information that's out there. I've got at least 25 years in self-direction, and we'll give them 5 free investing reports. All they have to do is go to this website there, and feel free to send this presentation to your people if you want to, Grace.
I will, yeah. So there's a couple more questions. Derek, do you want to ask yours?
Yes, and sorry for the background sound. On the previous slide, you had something that said ways to explode your IRA, over contribute. I was wondering, can you maybe explain a bit how one would over contribute to your IRA?
Yeah, I mean, basically what you would do is put in $50,000 and you're only allowed to put in 7, or you're only allowed to put in 20, depending on what type of an account it was. Right now, if you over contribute to that and you take it out in the same year, there's no harm, no foul, no penalties. If you over contribute and it goes past a year, then you'll pay a 6% on that over contribution. And let's just say you could only put in 10,000, but you put in 50, so you'd have a $40,000 contribution. I mean, over contribution, so you'd have to pay 6% of 40,000, which would be $2,400, right? If I did my math right. And we've seen people that have over contributed on purpose because they were getting into a good deal and they wanted it there. But now, let's say you did that for 1 year. Let's say you did it for 2 years and you paid, $2,400 each year, so you're into it for $4,800, and you paid the tax. That was the tax on those years. If you took that $40,000 out in the 3rd year, then you wouldn't be paying that 6% tax anymore. So let's just say you were making an 18% return. That would basically limit your return to 12% for those 2 years. Does it make sense? Derek?
I think so, thanks.
Yeah, I mean, some people see that and do it, and it's worth it. It's a small, I don't think it was intended to over contribute, but people sometimes make a mistake. They make too much money to contribute. They had a really good year. They put the money in the beginning of the year, and their accountant tells them, you know, in tax time in the next year that you put too much money in. So they have to pull it out or pay the tax on it.
Scott Minder writes 900 million. Why?
He said, do the math.
Yeah,
That's the
That's the commission. I love it. I
commission
love
on
it.
300
on
30
30
trillion dollars is $900 million.
Is that enough?
That's enough. If you can get all that investment, yeah. Brad has a question. Do you want to ask it, Brad?
Is this 23-year-old Brad?
This is 23-year-old Brad. How do you do a lump sum addition to the IRA that is more than the yearly IRA limits? You're muted, Brad. We can't hear you. You want me to unmute?
Unmute.
Okay, Brad, you're.
Okay. So can you hear me now?
Yes.
I can.
All right. Well, I've had a couple of different investors that have put their money in IRAs to loan on real estate, and one put sold a piece of real estate, and he sold $250,000 as a one-time contribution. I have another gentleman that's a dentist, and he put $500,000 in there in 1 year to use for his IRA. So how do they put those lump sums in when it's that kind of money?
Well, it depends on where that lump sum of money came from. Did they transfer it from a 401k?
But I know that the guy with the 250,000, he sold a piece of real estate and he put it directly into his IRA, which he takes his IRA and he loans for other real estate. But he sold a piece of real estate that wasn't in his IRA, and just put it in. The other guy was a professional and he had that 500 out of something, but he put 500,000 all in at one time.
Well, I mean, if like Grace had, let's take Grace as an example. She has a traditional IRA, right? She can roll that over into a Roth IRA, you know, 500,000, and pay the tax on it. If the dentist put that money in and he had it in another plan that was able to be moved to an IRA, that's one way of doing it. If the other guy did it from the sale of a property that wasn't in the IRA, that's hard to understand unless he had income or something that was there and he had a cash balance plan of some sort. But that really wouldn't be allowed, and maybe he over contributed and paid the taxes on it.
I don't know, but you know, over the years, if you started out 20 years ago and you kept putting $6,000 in there every year and then 65, how do these guys get $1 million in there to reinvest?
How do they get them? Well, number one, they can be putting money into a SEP or a simple, which isn't 6,000, right? When it started out, it was 3,000 and 30,000. So they can be doing that, but that money is compounding daily, right? If you've got it invested in there, and if you buy a real estate building and you use leverage on it, that's another way of goosing it. But if you look at that report, there's 20 ways that you can up it. Let's say some of the guys that put $100 down and took over the mortgages in their IRAs in 2009, right? And now 10 years later, 2019, those properties have basically doubled if you did it in Florida, and sometimes 3 times that. And all they did was put their $100 into it and paid the mortgage off with the renter's cash.
So if a person had a lot of money in a SEP, and he can roll that over into his IRA, and that's how he gets a big IRA built up that he can do his.
Yeah, if he has his money in a SEP, right, he can make that into a self-directed account. There's, you know, multitude of ways. Some people inherit it from their parents and their IRAs.
I see.
Not me.
Say it again.
That's a good one, Grace.
I get no inheritance.
Yeah, well, welcome to my world.
So I just wanted to mention for the next slide that you were showing, and contacting you. I just remembered while we're sitting here is that a few years ago, I contacted you and did a wholesale with my IRA, but I partnered it with my Grateful Nuts Homes, which does the flipping, and then and the other half came from the IRA. So then at the end, I was able to, just wholesale it and split the income between the two. One was income earning, the other one's, just straight to the IRA. So
Way to go.
and that's how easy you are to get a hold of. And I'm not even a client yet. So.
Cool.
Good.
Yeah.
That's awesome.
Yeah.
Good news.
Right. And Brad, if you look at that 20 ways to fund your investment, you'll see some ways that will explode those IRAs. It's
Okay,
like
because I could never figure out how somebody could build up that kind of money to buy and sell real estate when you start out at such little amounts.
Well, if you got to go study what the smart people do. I don't know if you remember Mitt Romney.
Yeah.
He ran for president a few years ago,
Mhm.
and he gave his tax returns, and everybody went pouring through them like nobody's business. And they made a big deal about his 100 million plus IRA. And you know that he wasn't investing in things that he didn't have personal knowledge of, but there's people out there that grow those IRAs even with the the income limitations as well as the contribution limitations on income. But that 20 ways to fund your investments, you'll see different approaches there and strategies. And if you need more information than that, feel free to call us and I'll help you out.
Okay.
Because
Yes,
you don't
strategies
because you don't
for-
know much at 23.
No.
I got you on that one there.
Well, and now that I'm no longer 23, are these things that can be done? I mean, I'm into retirement and I'm using funds and at this point, risk is a big thing for me.
Yes,
Did I miss the boat?
No, you didn't miss the boat at all. I mean, obviously, like everything else, when we get to our age that we should have done a lot of this stuff sooner. But to me, it's not too late, until you're dead. So I say, yeah, you should look at it. I think that, see, I don't like people telling me what to do, right? And I feel if I have a traditional IRA, number one, the government's telling me I have to take money out of it. And number two, they're telling me how much I have to take out of it. And I said, I'm not doing that. So I started converting all of my stuff to the Roth IRA because then I don't have to take my money out and I can take whatever out I want. And if I want to limit let's say taxes go up, I'll take more out of my Roth IRA than I will out of my traditional. But let's say my guess was wrong and taxes go down. At that point, I will take more out of my traditional account and less out of my Roth account. So I have options by having both of them. And I'm big on having options and trying to have things go my way more than the people keep trying to jam things down my throat.
Right.
I don't know if you feel that way or not as you're getting older, but you can talk about all the discrimination out there, but the older you get, I'm starting to feel I'm getting discriminated against,
Yeah, in some respects, yeah.
Yeah.
I felt
Well,
like that for a long time. I haven't worked for another person since 1981. I've been on my own. So
yeah, well, even my kids are telling me, oh no, it's too rough out there for you to go in the boat today, Dad.
never.
Yeah.
So, but yeah, it's not too late. If you have a financial advisor, talk to them. A lot of financial advisors tell you not to do the Roth IRA. But, call me and we can talk about the pros and cons of it. If you go on Google, half of the people tell you it's not a good thing. The other half tell you it is a good thing. And, but I believe, you know, I'm on the side that believes it's a good thing. I want to pay the tax on the seeds, not on the crops.
Right.
But I also grow my accounts pretty good. If you're making 1% in a CD, then having a Roth or not having a Roth probably doesn't really matter.
Okay. All I know is my Roth is, you know, it's not a very big one, but I gotta tell you that its balance really hasn't changed over the years. You know?
Yeah.
You know?
Yeah. Well, how's your house done over the years?
My house,
Yeah.
surprisingly well since I moved up here 5 years ago, but I lived in Southern California, so that's, you know, I did pretty well down there.
Well, okay. And your house did you buy your house in Oregon?
Yeah, here in Springfield.
Yeah.
Yeah.
And it did good too?
It's done really well. I'm really surprised. I wasn't expecting it to, but it has.
Oh, there you go. I mean, that's, to me, real estate seems a lot easier, you know?
I know.
I don't know. I mean, it just kind of happens and I don't have to work a lot, you know? Brad's probably a lot smarter than me and can make money on anything that he touches and has all the formulas and stuff. So he can, you know, if you stuck with him and he never does any bad deals, you know, then I think you're even going to be better, you know? I'm going to start looking at him.
Yeah. Okay.
It's good advice.
Any other questions or was
There
this go ahead.
I was gonna say, there aren't any other questions. I did post one early in the thing, if you want to answer it for me. Let's see. So let's say I come up with a pinch. You're the custodian. Is that what it is, or for my IRA? And if I come up with a potential investment, how long does it take for you to review, your office to review the request, and who controls the bank account?
Well, there's a couple of things, right? You can have a checkbook LLC, which I don't recommend. I would much prefer you to do a solo 401k if you want to control your checkbook. I think those are going to be much safer in the future than the than the IRAs. Our office, 99% of the stuff gets out within 48 hours of when all the paperwork is submitted properly. And I think we've got one of the best records in the industry.
Okay, because
Does that answer it?
currently my self-directed IRA is an LLC, and it's a checkbook IRA, or I guess. What do you call it? Checkbook,
Yeah,
right?
no, it's a checkbook IRA LLC. Yeah.
Yeah. And so I should have a solo 401k. It's probably going to be safer due to IRS changes and that kind of stuff.
Yeah, I mean, the IRS lost that. The IRS lost the case. You know, Baker McKenzie out of Chicago litigated it, and the IRS was stupid with their lawyers and fought it on two of the weakest points when there was two stronger points that, you know, almost every attorney out there says it's going to get overturned. But the argument comes is, what are they going to do for all the people that have them? And the IRS specifically 4 years ago made a category for those checkbook LLCs, and they make the custodians and administrators report on them. So the IRS knows that you have those. And the two things that get audited the most in this IRA world are those checkbook IRAs and the unsecured notes.
Okay.
So that's why I don't recommend them. We do them, you know, but I just want everybody to go into, you know, with their eyes open. I'm big on security and transparency.
Okay. Awesome. Yeah. So I think that's all the questions right now.
Okay. So yeah, if anybody wants to open up an account, it takes 10 minutes. You can go online and do it. It's usually a $50 enrollment fee, but again, Grace says let it go. So we'll do that if you open an account and transfer, rollover, or contribute 5K or more. And if you have any questions or you want to set up a consult with one of our executives, call that number there, and we will set that up, or write us an email and we'll set up a time that works for you. Even though our office hours are 8:30 to 5, you can see we're out at night. But whenever I get invited to talk to, you know, a good group, I'm ready to go. I like what I do.
How's that one?
So,
Well,
yeah.
Carl, thank you so much for the discount, waiving the $50 enrollment fee. Thank you very much for being here tonight. It's almost midnight. It's where you're at, I think, or maybe 11. And I really appreciate it. And so I will post these, you know, your website addresses too. Here, let's see if I type them down here, because we can't really click off of your thing. And I don't know if
Not off of my slide.
yeah. So
Yeah, I didn't know the best way to do it, Grace, so we should have probably talked about it more. But
yeah,
if you,
right.
I can email them to you tomorrow too if you want.
Okay, so I will put up here HTTPS. Oh, I can't type. Yeah, in the chat, and then I'm just trying to. Will you back one screen, please?
Can I?
Yeah.
Yeah. Yep.
And that's where we can get the downloads at this one.
Yep. Or just grab the phone number there and call us and we'll send them to you.
Oh, well, I screwed up on something there.
Yeah. Well, and let me ask everybody that's still listening here, was this helpful tonight?
Yeah.
Yeah,
it
Yes.
was.
excellent.
Absolutely.
Definitely.
Absolutely.
All right,
Most
good. I'm
likely you're
glad
gonna
you.
get a call from my wife and I.
Okay, great, Scott.
Perfect.
And the next screen is the phone number, right? Okay. All right. Well, I did some screenshots, so I'll get this out to everyone.
All right. Yeah,
And Carl,
and
you're on the East Coast, correct?
we are.
Okay.
Is that, are you going to hold that against me?
No, not at all.
All righty.
We'll just teach you one thing. All right, Carl, we're going to teach you how to say Oregon.
Oregon?
Oregon.
Oregon?
Oregon.
And not Oregon. Yeah.
Oh, did I say Oregon?
Yeah.
Oregon?
Yeah.
Oregon?
It's
Okay.
our thing.
I want to tell you the best way to remember how to say Oregon is, well, you wouldn't say Texas, it's Texas.
Yeah, Scott, you've been around.
Brad.
That was Brad.
Brad.
Oh, sorry, Brad.
I'm only 23, I don't know better.